Nexus, we're basically trying to do the insurance part of the DeFi stack, though we're not actually insurance. We're a kind of people-powered alternative. That's what we're aiming to do. Might just go way back because insurance is very, very old. It's millennia old. It's basically groups of people coming together and sharing risk on a community basis. And one of the, I'll start with a picture of this guy. So this is I guess a logo or an emblem. It's actually on the top of the first of the building that of the first insurance company I worked for. And it's really kind of shows what insurance is all about. So what the picture is actually showing is a group of sticks being held in a bundle, and the man's trying to break them. And I don't know if you've ever done this yourself, but if you got one stick, you can easily break it yourself. But if you put them together in a bundle and wrap them up, then it is incredibly hard to break. So the whole point is that that's kind of what insurance is about. We group together as a society, as a group of individuals, and we protect each other, and we actually become stronger and more resilient as a community. And so I guess one of the earliest examples of this is if we go back to China, and then the river merchants would take their goods down the river, and basically they could lose all their goods because they capsized on the rapids or whatever. So what they actually used to do is they used to team up and share the load. So they'd share some of their own load they put on other people's boats and stuff. So they'd share the risk together, and then if one of them lost their cargo, then essentially they'd only lose the part of each, and so everyone was a bit more resilient. And so that's kind of what this is all about. Insurance is essentially a group of people coming together and sharing risk. And so one of the challenges with that is that on a community basis, usually you kind of have to trust some group or subgroup of that community to work out who pays claims or who decides what a valid claim is. And one of the ways we used to do that is essentially trust the elders in a community to decide. And that works fine within that community, but it often struggles to scale. So if you've got one community on one side of the hill and another community on the other side of the hill, the people in one may not trust the elders of the other to pay on claims. And so you struggle to grow. And so mutuals have this inherent disadvantage that insurance works by large groups of numbers and pooling of risk, but they struggle to grow, and so they struggle to become efficient. And so over time, over many years, what has happened is that model has been replaced largely with shareholder-based insurance companies. So what the shareholder company does is essentially it bridges the people who want cover, the individuals, with capital markets and capital needed to back the policies that have been written. And so essentially right now, they are the most efficient way we have of connecting capital markets with people, and that's what insurance is actually about. So what our model is about creating this one, or replicating this model at scale, allowing it to scale up and compete with the big insurance companies in the world on a mutual basis. And why would you want to do that? Well, essentially, a mutual basis, the whole thing is run for members, by members, and any benefits go to the membership base. So the money doesn't get taken by the shareholders, it gets distributed to the membership base. And so this is essentially a DAO. And so that's the type of thing that we're building, or we've built. So just very briefly, what we're building is what we call a decentralized risk carrier. If you have a normal insurance company, you've essentially got customers or members up the top, and they interact with the company, and then you've got shareholders underneath. If you have today's mutual, you essentially have a very similar structure. It doesn't have any shareholders, it just has members, but there's essentially a company or a central organization that actually decides on claims and operations and does the admin and sales and all of that. And so essentially the members kind of outsource those responsibilities to a company. And so it has the benefits of working for the membership base, but there is a kind of that tax in the middle, or operational costs. And there is still that company. What Nexus we're doing is essentially devolving as much as possible, not absolutely everything, but devolving as much as possible to the membership base to allow them to run it, to them to decide on claims, them to work out what the pricing is, them to work out how to actually operate this on a day-to-day basis. We use smart contracts on Ethereum to do that. So I'll kind of go through some of the more kind of interesting aspects of some of the new stuff, I guess, we're doing. And one of those is we're actually a hybrid between the company and a DAO. We're a legally linked DAO. You can call it whatever you want. We call it a digital cooperative. With the company model, the legal entity is here with the shareholders and the company, and the members are outside that. With the DAO, there's no legal, pure DAO, there's no legal entity at all. What we have done is create this legally linked DAO. So we have a legal entity in the UK, and so if you join Nexus Mutual as a member, you actually become a member of that membership organisation in the UK. And we have board members. It's a company, it has to have board members. And so some of those members are also board members of the company, and they have slightly more powers in the system than other members, not as extreme as a regular company would, but they do have that power. And so just to kind of describe that a bit more, we're setting it up as what's called a discretionary mutual in the UK. So that's the framework, or the legal framework we're operating under on the insurance side of things. And the whole point there is that the members have discretion over which claims are being paid, and therefore it's not a contract of insurance. So we're offering discretionary cover. And so we have a company, Nexus Mutual Limited. It's a UK membership company. It doesn't have any equity. As I said before, each member joins the company. They become a legal member of the company. And that means you have legal rights to the pool of funds that the mutual owns, and also which are kind of governed by tokens. And so that actually means the token actually has legal rights, which is interesting. And one of the main benefits the two main benefits that we're actually doing this for are, one, that it gives you limited liability on a per member basis. So if you're a member of a DAO and the DAO does something wrong, then potentially you're unlimitedly legally liable for anything that the DAO does, and someone could come after your house, as an example. But here you get limited liability, and we have a DAO that can write a contract. You can pay. You can get a bank account. You can get someone to do some consulting work for you. And you can do it, write an invoice and a service agreement and a contract, and it becomes a whole lot easier. So that's kind of one of the good benefits of what we're doing.
Sorry, is it a company limited by guarantee?
It is a company limited by guarantee.
Thank you. Sorry.
So, more generally, insurance. Insurance exists so that other people can take risk. It basically underpins every industry in the world. If you want to launch a rocket, you get insurance. If you want to build a train line, you get insurance. If you want to get a house, you have insurance. Like it's there. It's always there. It's kind of fundamental financial infrastructure. It's so that we're more resilient as a society. And crypto doesn't have any access to insurance. Simple example. We tried to get insurance as a company, regular insurance, not crypto native insurance, just regular business type insurance. We went to 2 brokers. I kind of know what I'm doing in the insurance world. Went to 2 Lloyd's brokers. I got 12 responses, and they all look like this. Basically, you have something to do with blockchain or crypto, and therefore the answer is no. Even though it's just regular business insurance, it's not actually like cold wallet storage or anything like that. It's nothing like that. It's just regular business insurance. And they just said no, we refused to quote. So we didn't even get a quote, let alone able to place cover. And so that's just a very simple example of just basic financial infrastructure that this industry doesn't have access to. And so that's actually quite a good place to start a mutual, because a mutual is kind of a community do-it-yourself version of an insurance company. And so that's where we're focusing our first products on crypto native risks. And getting into the product, as I'm sure most of the people here are aware, there's a whole bunch of assets being locked in DeFi smart contracts as an example. It keeps going up, apart from the value of Ether slightly going down. But we got 500 million in DeFi, we've got $1 billion in multi-sig wallets, we've got a whole bunch of DAOs coming online. How many forks of Moloch are we going to end up with for funding and stuff like that? We've got payment channels, we've got a whole bunch of different things. And obviously there's a technical risk that the smart contracts could fail and they could be hacked. And so that's where our product comes in, smart contract cover. The idea is that a claim is paid when or if there is a unintended usage of the code that leads to financial loss. So, so one of the interesting things is it's very, code will always act as coded, but it may not act as intended. Obviously, like the DAO hack was an example. No one, like they didn't code that to be able to be drained. Like no one thought that that was what the intention of the code was, but that's what happened. So basically, we have potentially buggy smart contracts holding lots of funds. To me, anything that's interesting on Ethereum will actually either hold value or transmit value. And therefore, it has the potential for being able to benefit from smart contract cover. So that's our first product. Definitely focused on crypto native risks. We're exploring a few others, but definitely think smart contract cover's got a lot of potential. I'll go through a couple of examples. So I think InstantApp was talked about a bit recently. It allows you to flip assets between Compound and Maker quite easily to make the most efficient usage of the interest rates, etc. They put a layer of smart contracts on top of Compound and Maker. And so they're actually holding recently about 30 million. They haven't actually got an audit yet. I'm not saying that there's anything wrong with the contracts, but it's basically two guys in India who've done some really cool stuff and really awesome stuff on the UX side, but they may not necessarily have the money to get an audit. I think there's been a crowdfunder or someone's getting them an audit done now. But the point is that there's a whole lot of money in this thing and it hasn't even had audits yet. So we're kind of, in some ways, running before we can walk, but yeah. Another one, Edgeware. So this was an interesting one. You can, you could, or I'm not sure if it's still going actually, I think it's finished. You can lock your Ether in the Edgeware smart contract. So Edgeware is developing a parachain on Polkadot, and basically they're using this as a signaling method to create an initial community. And so what you do is you lock your Ether up and you earn a new Edgeware token when it launches. And so they've got smart contracts. It holds a lot of value. A lot of people are quite happy to forego the opportunity cost of locking their Ether up for 3, 6, or 12 months in the return for free Edgeware tokens. And so there's two things that that you're actually losing out on there. One's the opportunity cost of doing something else with the Ether, and the second one is the technical risk of the smart contracts failing. So interestingly, on this one, Edgeware have actually got 2 lock drop contracts. The first lock drop contract had a bug. No one's funds were lost. There was a griefing attack where someone could actually work out where the, I won't go into the technical details, but basically they could lock your funds in advance. And someone realized this, no one lost their funds, they deployed a new lock drop contract and everything's fine. But the point is this stuff's hard. Argent, so I think they were just talking just before. These guys are building or have built a really fantastic mobile-based wallet, and one of the main benefits of their approach is that it is smart contract-based, which means that you can do some really cool stuff like blocking, having time delays and things about setting up new accounts or who you send money to and making sure you've got a recovery process, and also interacting natively with other DeFi protocols like Compound or Maker or something. And so all this intelligence and really smooth user experience is underpinned by smart contracts. And so those smart contracts are again holding user funds. So you can do all this great stuff, but in theory there's also a risk that the smart contracts could fail. They've done a whole bunch of audits, and they're very well focused on security. They're also looking to buy cover with us to give some of their initial users some cover. And if you think about this more broadly, this is only really we're only really at the start here. But if you've got a smart contract-based wallet, with all these features that looks like an online bank account, then you cover that with Nexus, and all of a sudden it starts to look very similar to a bank account with FDIC insurance or the equivalent in the UK or Europe or whatever. So not a bank account, not insurance, but the same things, the same features from a user point of view are being rebuilt in the DeFi world. So I'll just go into some of the more specifics on how our product and the pricing and the various other pieces work. So one question we always get, obviously, is how do you price the risk of the smart contracts failing? We use a two-tier approach to this. So we have the first tier being the hardline is essentially the base algorithm, and that roughly works out how battle tested the code is. How long has it been on mainnet? It's held lots of funds. It hasn't been hacked, therefore it's likely to be secure. So basically what happens is the price starts off really, really high, possibly at an uncoverable, non-economic level, and then it drifts, comes down over time as it gets more and more secure. And then that doesn't work for newly deployed contracts because they haven't been battle tested yet, so you can't actually buy cover on them without the second tier. And the second tier is the staking process. So what happens is, as a member of Nexus, you can join Nexus as a member, then you can buy our native token, and then what you can do is you can stake that token against specific smart contracts that you think are secure. So for example, if you think that, that Compound is secure, then you can go and stake on Compound. And what happens is the price drops with more and more staking, kind of like a prediction market, not exactly the same, but kind of like a prediction market. And then what happens is, as a staker, when people buy cover, you can get a share of the rewards, or you get a share of the premium, essentially. You earn a commission. So you become like you can become like a distributor as well. And if there is a claim, then some of the stakes will be burned. So the mutual will pay out the claim and then burn stakes equal to the claim value, as long as there's enough stakes. So what happens with staking is the more and more staking we have, the lower the prices, the more usable it is, and the more capacity we have. So our goal is to also have a community of smart contract auditors or skilled professionals. We have a bunch of gamblers there right now, which is also useful. But we're also trying to get more and more auditors to get more expertise behind this stuff, so they can put their money where their mouth is and have some skin in the game as well.
Is the current margin that a staker would make back their principal plus reward? Okay.
Yep. So assuming there's no claim, then essentially they get back their full stake and they earn additional tokens. And the number of additional tokens they earn is based on how many people buy cover, essentially. Another interesting thing about what we're doing is we're one of the first live examples of a bonding curve model. And the main reason we actually have a bonding curve, we just step back. If we're creating a new token, a lot of tokens just create a fixed supply at the start on one extreme, and then they never create any more new ones, for example. And they raise a certain amount of capital at the start. One of the whole purposes of what a mutual actually needs to do fundamentally is get capital in the mutual to back the policies that it writes. And then as it writes more and more policies, it needs to raise more and more capital to back them. So it needs a dynamic way of raising and distributing capital in the future.
This is not really correlated to your risk. It's totally decorrelated with the risk you have. Your bonding curve has nothing to do with the risk you're underwriting.
Oh, it does.
Oh.
Yeah, I'll get into it. So essentially, this is a mechanism of being able to attract new capital when the mutual needs it, and to encourage it to be redeemed when we have excess capital. So what happens is, the pricing is more or less primarily driven in the short term by this MCR percentage. And the MCR is like the minimum capital requirement, or the ratio of the minimum capital. So it's basically the ratio of the funds held actually in the mutual, the funds that it actually has, versus the funds that it needs. And so the funds that it needs is basically worked out on which covers it's written. So if it writes more and more covers, it needs more and more funds. And so that's to answer your point. That's
the market's perception of the risk, not real risk. There's a huge difference. That's
sorry,
what I mean.
the
You have no real correlation between the real risk and the perceived risk at any point in time. And you would totally underestimate the risk and be totally wiped out.
we have a formula which determines the capital that we need based on the policies that we have. That is based on the principles of insurance regulation. So we've based it off the Solvency II calculations. And so that's essentially the calculation of how much we need. Then there's the market side of it, which is how much the mutual actually has in it, which is up and down, yes. So the ratio as an end result can be up and down based on market perceptions, but we also ensure that the mutual always has enough funds to be able to meet itself. So we basically restrict, you can't cash out your tokens unless we have excess funds. So the bonding curve allows purchases at any time, but you can't cash out your token unless we have more than our minimum amount. And so basically what happens is over time, as we write more and more policies, this minimum capital requirement becomes a bigger and bigger number, and then it will put a dampening effect on the token price to encourage more people to put money in, and then the whole thing grows. Assuming we, as an example, assuming we just stay at a constant level, just writing covers and they go on and go off at the same rate and we're just kind of roughly at the same size, the minimum capital we need stays constant, then what happens is the policies that keep getting purchased essentially leave a surplus in the pool along with the investment earnings of the asset pool that we've got, and that means over time, assuming we don't need any more capital, then the ratio just keeps climbing and climbing. Assuming no one's cashing out, then it keeps pushing the price up and up and up because profits or surpluses are being made by the mutual.
How would you describe a reinsurance mechanism on this? Because normally in insurance, everybody sells it off straight away. So here, I can't see how somebody will be able to do a staking.
You could do a synthetic
So-
asset of the staking asset.
It's the staking of the reinsurance.
So the reinsurance and insurance are basically the same thing.
Yeah.
So this, you could mimic this model either way.
But as you mentioned before about the other token holders being able to stake against particular smart contracts, in effect that is reinsurance because they will take part of that risk.
Yep.
That risk if they're putting up their tokens to back particular smart contracts.
Yeah, yes. It has similarities. Probably not exactly the same, but yeah, it does have similarities.
You don't just hand it off though. I'm sorry.
No. It's not kind of it's not kind of reinsurance in some ways. The staking is kind of like, as a token holder, you're essentially taking diversified risk against all the covers that the mutual writes. You're sharing risk. That's the whole point. As a staker on a specific smart contracts, you're kind of doubling down your risk. You're saying, I'm taking that diversified risk, then I want to double down on this one. I think it's good to enhance your returns. That's what you're doing. So that's kind of the bonding curve model. And so the bonding curve's live right now. You can purchase tokens if you want to. You can cash them out if you want to. You can get involved. And so I guess I've described this in a bit more detail already. But essentially, if you know Uniswap as a liquidity provider, this has a lot of conceptual similarities. A few differences, obviously, but conceptually it's the same type of thing. So basically, you contribute Ether into the capital pool, you get tokens in return, so it's kind of like a liquidity provider in Uniswap, and then as people purchase cover and surplus is generated, that surplus remains in the pool and is essentially owned by the token holders, and so you essentially share in that. And so the mutual members or the token holders basically own all assets in the capital pool, and that's how it makes money.
But the token holders are not members of the company limited by guarantee?
Yes, they have to be.
Right.
So
You have to sign up and...
yes, so there's a whitelist approach. There's a whitelist and a KYC, and so the first step is you become a member of the company, you pay a very small membership fee, and then you have the ability to buy tokens, and the tokens can only be traded amongst the members, so there's a trading restriction. And so basically we are creating a mutual company
Yeah.
so the token is quite different to regular tokens, but you can buy the tokens directly from our application on the bonding curve, and you can sell them, assuming we've got excess funds, you can sell them at any time as well. So yeah, there's quite a few unique differences on our token versus, I guess, standard tokens, if there is such a thing as a standard token. Yeah, so I was going to show you a quick demo, but I can't because of the Wi-Fi. But essentially, it's live now. You can go and have a look. You can get a quote. You don't even have to connect MetaMask up to get a quote. So basically, all you have to do is enter the smart contract address that you would like covered for the system, how much cover you would like, and how long you want the cover for, and you get a quote and go from there. And if you'd like to proceed, then you sign up. Obviously, one of the tricky things is, how do I know the smart contract address? So we've set up ENS names. So if you want to get cover on MakeItOur, then you type in MakeItOur scd.nexusmutual.ether, and then that gives you a quote for MakeItOur, and there's a whole bunch of other ones there as well. So I guess 2 points: you can buy cover denominated in Ether, or you could buy it in DAI. So for example, if you want to get cover on MakeItOur, you've probably got Ether locked up in MakeItOur smart contract, so it may make sense to buy Ether-based coverage. If you're putting DAI into Compound, then you might want to buy a DAI-based coverage because that's your risk. So, so you can choose either of those two options. And in the event of a claim, you basically get paid your whole the cover amount you chose. So there's no check that you bought 10,000 DAI worth of cover and you only lost 5,000, so you'd still get the full 10,000 of claim. There's no check about your individual loss. Yeah, so you can gamble on it if you want to. So yeah, that's basically us, and a quick whiz through of what we're doing and the interesting parts. More broadly, as I kind of alluded to before, DeFi is kind of, in our opinion, building a parallel financial infrastructure, and as part of that, you need insurance, and so we think that this is fundamental financial infrastructure for a new economy, and that's what we're trying to provide. So thank you. Cool. Questions? Yeah.
Would you mind using the microphone?
Yeah.
I got it now.
All right. This is great, and I've sort of looked at this for a while. One worry that I have is slightly that you found a very good way of setting up an unregulated insurance company, for want of a better term, funded by crypto, which is good. But I'm worried about the product you're writing, because smart contract insurance is basically binary. I mean, either it's an utterly catastrophic, total loss type situation where everyone gets wiped out, or everything's fine. It's 100 or 0. And that's a tricky risk to write in insurance, I think. And I wonder to myself if it wouldn't be better a more hybrid approach, or because you have a pool of capital and you can write insurance effectively, to sort of write insurance on traditional pools of capital yourself, a little bit like a Lloyd's syndicate, if that makes sense, or being part of a Lloyd's syndicate, or writing on stuff that's in the current real world, rather than going the extra step and writing smart contract insurance when smart contracts themselves are so binary.
Yeah, sure. So there's two things there. First, the binary type risk. The way we manage that is essentially we put capacity limits on any particular smart contract. So we can only write, for example, capacity on Compound up to 20%, or anything else, up to 20% of the assets that we hold. So to make sure that if there is an event, then we've got enough money to pay. So that's the way we manage that. And at the moment, we're maxed out on Compound, as an example. So we need to grow further for more capacity to open up. So that's the way we manage that risk. So we have to grow what I call it growing horizontally before growing vertically. We have to get diversification across different smart contracts before we can start growing in size, and then that opens up capacity on everything. Secondly, this is a very crypto-native platform to actually use. You need Ether, you need MetaMask, you need DAI or something, right? So this is for crypto-natives right now. The crypto I guess, basic infrastructure for fiat on and off ramps and all that type of stuff is not quite there yet. It's not quite smooth. And so what we discovered through research was that the number of people that wanted regular insurance products and had crypto was 2. So we built a product for crypto natives that was covering crypto native risks that they couldn't get covered elsewhere. So the regular insurance industry is nowhere near offering this type of cover. And so they basically only have this option. And so that's, we believe we've, at the early stages of product market fit for this product. So as long as we can manage the risk appropriately, then we think this is the way forward. In the future, we plan to stay crypto native risks for a while, get scale. But if you want to target more regular insurance products, you need a certain level of scale to be efficiently offering those types of products. So we need to get that scale first, and we can get that within crypto native first. Yeah.
For pricing the size of cover, is it only the value that's being locked in the smart contract, or are you also pricing the risk of oracles and sort of ambiguous aspects?
Yeah. So there are actually, I categorize the risks of interacting with a smart contract into 3 buckets, and we basically cover one of them. There's the technical risk of the smart contracts failing, which is what we cover. Then there's the centralized admin, Oracle, external, basically external to the system type stuff, right? So we don't cover that right now. But I think that's pretty impossible to cover, actually. If we did, then someone could just attack the system. Essentially, you're ensuring some random guy on the internet is going to behave as you want, which is really hard. And then the third one is economic incentive failure, which is a bit more ambiguous. For example, if the MakerDAO's interest rate mechanism doesn't work and the DAI peg fails, then DAI may be worthless, but the smart contracts will still operate as intended. So we don't cover that one yet, but I see that there's potential for us to be able to cover that stuff in the future, but we need a bit more experience first.
Just a simple question around where one can go to look at price of NXM, rates, returns. Is that, it's not on your website right now, is it publicly, or
yeah,
it is?
There's a network status page on the dashboard.
Okay.
Gives you the current bonding curve price, and you can just see, the full assets of the mutual, the covers that have been written, and the current price.
Okay. I came in maybe a little late, so I may have missed this. Can you walk through like some just numbers on like what a typical participant can earn? Like a simple example. Where there's great rates of return right now, where there's less, yeah.
So I don't have the numbers right now. We're really quite early. Most of the users are actually using it for buying cover, and that's the main purpose of the whole thing. If you want to get involved, and to be honest, the mutual is still quite early, so it's really not kind of at that stage where it's spinning off material surplus right at the moment. So it's really people getting involved from a longer term perspective right now.
Got it.
Yep, so go to the front and then go, Steve.
Yeah, so just a quick question on your approach to customers, and we had Argent in here previously, and clearly a use case there. Are you looking at this as a product that you directly, or that is directly accessible to end users, or something that is typically packaged up through an Argent or?
Insurance is always a secondary product. Like you don't go, yeah, I want insurance. You go, I want to put money in Compound and I want that covered, or I want to put money in Argent and I want that covered, or So we, by nature, are that secondary purchase, so therefore we need to work with the distribution channel, which is the primary purchase.
Yeah.
And so there's 2 main angles there. One is the kind of business to business side of things, which is all about partnering with smart contract security experts. When new projects are developing smart contracts, they're looking to release, they want to give confidence to early users, they want to buy cover on their own smart contracts to give a safety net and encourage early adoption. And that kind of comes through the security auditors phase. And then there's the other group, which is primarily where our sales are coming from right now, which is kind of the end users of DeFi, and they're just going into Compound, Maker, Nuo, DYDX, Fulcrum, all of that type of stuff, putting their assets in, earning returns, and then coming and also buying cover because they're worried about the technical risk.
Yeah, and sorry, I did have a follow-on which was just related to that, the compliance around new user onboarding, and I guess you're working with unregulated tokens today. they might not be regulated for that much longer in some cases. In the event that there is a KYC type requirement that you need to comply with, do you have a plan for how that would be addressed? Or
So we have KYC right now.
for individual end users?
Yep.
Okay, question answered then. Thanks.
Yeah, Steve? Yep.
You kind of mentioned earlier on about kind of the possibility, obviously, of developing independently from, you know, the traditional insurance world. When do you see the kind of, would there be a crossover at any point where, for example, you talked about Lloyd's syndicates and they may see, you know, putting some money in NXM as a great, you know, way of diversifying their risk or getting exposure to this kind of risk that they don't actually have themselves. Is there a future where you see that kind of happening, and is it soon or is it 10 years' time?
Yeah, so I see there's two main options on that front. Firstly, the regular insurance industry is very risk averse. Their business is risk, but they're very risk averse. And so they will likely enter crypto native risks via someone else. And hopefully that's via us. And so in the way they might enter is by actually providing reinsurance or excessive loss coverage on top of our pool. And the mutual takes the first layers of risk, and we use that extra reinsurance type capital to scale up and offer more capacity to others. But they're not going to do that until they've seen a few claims being paid, they understand how it works and all the rest of it. And so maybe that's 2 years away, having conversations now, but you know, these things take a while.
I mean, if you like, you've got all these Lloyd's syndicates now that are setting up, specialising in, say, cyber
Yep.
and all this kind of malarkey. Could you envisage that those kind of specialised pools would see this as a subset of cyber?
Yes.
And maybe want to allocate some capital towards it?
Yeah, exactly. That's how they view it. Yeah, they'd see it as a sub-business line of existing business lines.
I'm kind of asking a follow-up question. I mean, literally, if you had two competing ecosystems, one that's truly crypto and the other one that's traditional, the traditional will be efficient in the sense of, okay, so there is no chance that in an open market, in a true reinsurance market where the market prices of smart contracts are either risk assessed via a betting market or some other mechanism, that you will have any chance. Do you see of any ways of reducing your cost?
So there's two things for efficiency from an insurance point of view. One's the administrative costs, and the other one's the capital efficiency. So obviously right now we're quite small, and so any regular player would absolutely dominate us from a capital efficiency point of view, but they're not entering the market, they don't have the expertise. So we have some time to grow. From an admin point of view, we estimate that we're at least 50% cheaper on a cost base versus a regular insurer. So, and that's because we're basically ignore blockchain, we're basically like a greenfields fully automated end-to-end insurance company. So, like there are two sides to it. We need to grow first to make sure we can compete on the capital efficiency side of things.
So just on the trading of individual contracts like the TCRs. So you said that once it gets to the minimum required capital, it's sort of effectively like gates. So assuming there was like a breach, I could sell out of that before other people, and then those people would be locked and wiped out.
Literally, you do front running on somebody.
So I could like build.
So yeah, basically, there's a claim that's been submitted. The mutual has to pay out a certain amount, and then people want to cash out down to the minimum. Yeah. So yes, entirely possible, but the primary purpose of the token model is to make sure we have enough money to pay genuine claims. And so what happens in that is it prevents the sale of, like, the bank run can't go the whole way because the smart contracts prevent it. And we make sure that we pay the claim, and then what happens is the token price would drop a bit further because we have a bit less money, and that encourages people to essentially refill the capital. Right. So there's, look, yes, that is new. We haven't actually paid a claim yet, so this has to be tested. But that's what the primary purpose of it is, to make sure we have enough money to pay claims.
Right, but yeah. So I guess my question was, it wouldn't freeze and everyone would be wiped out like 80%. The people that exit would be out and clear, but everyone else would get 100% wiped out. right?
So no.
So you couldn't sell as soon as you read the news before it was gated.
So you can.
'Cause it's a liquid
So
market.
right now, as an example, right now our MCR ratio is 130%. So we have 30% excess funds, and so we have basically 9,000 ether, and we need 7,000 ether in the pool, and so 2,000 ether of that could be sold at
Yeah.
any point. So that could be essentially front run when you know that there's a potential claim. Then it stops at 7,000, and say the claim is for 1,000 ether. Then the claim payment goes through, it drops to 6,000, the claim's paid, and the token price goes down to whatever it's supposed to be at 6,000. And because it's lower, the theory is that it will encourage more people to recapitalize back up the pool.
Right. But wouldn't it be fairer if, like, say Compound came to you and said, look, we think we've got a breach, and then you, like, locked up everyone and everyone, you know, paid the same price?
Yeah, then we'd also have control over the system.
Yeah.
Can you walk through a claims process and how that would work?
Yep. So basically the claims process from a customer point of view is if you think there's been an event, you go into the system, do one transaction, it puts a event into the kind of voting pool. So the other members vote on the claims assessment, and there's a staking process there. So if you want to be a claims assessor, then you stake the native token as a kind of bond, and then if it reaches the 70% majority threshold, say it's been approved, then the claim gets paid, and the claims assessors earn a share of the rewards for a particular claim. And we make sure that there's enough bond so that there's at least 5 times the amount of bond as per the claim amount that's being approved, so that you can't like bribe people to approve your claim and then pay them back. So that's the basic mechanism. There is a little bit more detail to it, but that's the basic mechanism.
In the time frame in which all this
So it should be resolved within a maximum of 48 hours.
Is there a sort of what we used to call CDS risk, where basically you can sort of take out insurance on someone else's house and then burn it down, sort of thing? So where basically you can know that you can blow up a smart contract, get insurance on it, blow it up, and sort of profit effectively in the way that CDS used to work in the 2008 crisis, sort of.
Yeah. If there's a bug in it already, yeah.
Right. If there's a 0 day available, you can actually price it. You can make some money by doing this.
If there's a 0 day that no one else has discovered for some period of time, then yes.
So it's an attack vector, effectively.
Well, if the 0 day has been sitting there for a period of time and people haven't noticed it, then yes. However, if you knew that, then you'd attack the system and potentially drain the money in the first place anyway. So, yes and no.
A direct way of attacking the smart contract. You might as well go directly.
Yeah, well, like you can just still attack the whole thing in the first place.
or like a leverage way to attack it.
Yeah, if you've got 100 million sitting in Compound and you can make an extra few 100,000 on Nexus, then I don't know, just go for Compound and do it first.
But it depends on the future scale of the whole.
Oh yeah, I totally agree. Yeah, no, there is that potential there, but the whole thing is like it won't be coverable without staking, unless it's been battle tested.
So yeah, like for example, you're not going to cover just some random smart contract off the bat type scenario. There would have to be some degree of
Stake.
time.
Yeah, so
Time and
basically,
existence,
one of the 2 things have to happen. A new smart contract comes out, it either has to be battle tested with funds and usage, etc., and that comes down over time, or there's staking, enough staking to bring it down. And if there's staking, then you pay the claim and burn the stake, and it's kind of a net.
Sorry, just one more. Have you done any kind of thoughts, calculations around like potentially? Obviously, there's a risk pool there that can potentially earn a kind of relatively safe, inverted commas, return if you're kind of utilising that and various other DeFi kind of aspects. I'm assuming that is also a surplus that would accrue to the NXM token holders over time.
Yeah, so insurance companies make a chunk of their money from earning returns on the float. So the pool of assets that they have. That's why Warren Buffett buys insurance companies, so he can invest the float in other things and just double up. So we've enabled that right now. It's not actually active. At the moment, the pool just holds Ether and DAI, but it's set up to hold any ERC20. And so you could, for example, allocate some of the asset pool to like CDAI or to Fulcrum DAI, I think, I don't know. Anyway, the different interest-bearing assets, and maybe I'm assuming that Rocket Pool are going to come up with a proof of stake token once ETH 2.0 goes live. And so we could invest in assets like that, which are perfect for insurance-like companies because they are relatively low risk of default, but they just provide a yield. And so it's fully enabled to do that. It's not currently active right now.
Theoretically, though, you could only do that with assets you could withdraw from instantly, right? So when you invest in Compound, you're not going to get the CDAI or the DAI back until the user reimburses the loan or pays back their loan.
Yeah. So we have two pools of assets. So there's a whole group of assets, and then we have two subpools. One is the liquidity pool, which is basically cash, and they're designed to pay out claims from, and then just like an insurance company, you actually hold illiquid assets. But you have to make sure you don't hold too many illiquid assets. And because the way it actually works is if a claim comes in and we know we don't have enough in the liquid asset pool to pay that claim, if it was to eventuate, we still have at least 24 hours before the voting finalizes, so we send off trades to Uniswap to rebalance the pool so we have enough liquid assets to pay the claim. So we want to make sure that we can invest in illiquid assets, but we also want to make sure that we can pay claims.
Illiquid assets in the pools you're insuring, like Compound, you're saying, right? So you actually...
Well, yeah. So that is definitely, that's one of the reasons we haven't actually enabled the investing stuff yet, because, for example, if we were to hold CDAI, then we're essentially accumulating risk because we're providing cover and like if the whole thing goes down. So we have to, like, it may make sense as an example to hold, Fulcrum USDC or something that's, it's a bit, I don't know what the answer is right now, but we have to be cognizant of that accumulation of risk when we add assets to the pool.
Or use a centralized lending platform, right? So something like Genesis, lending or...
Yeah, except our pool's non-custodial, so we're only holding ERC20s. And the whole point is that no one has access to the funds of the mutual. Yep. That's one of the key points. Oh, yeah, I don't know what time is. Is there any more questions, or we just call it? No? Okay, thank you.